Buenas tardes.
Good afternoon, ladies and gentlemen, and welcome to the third edition of our most international event, Finect Best Investment Opportunities Summit. A very warm welcome for those who've been following us since the very first edition, and welcome you all to those joining us on the third edition. When we were drafting this event a year ago, for us it was primarily important to connect investors with asset managers and professionals in that field. The world was very different from the current pandemic. The markets, the economy was living a very complex moment, perhaps the most difficult one in the past few years, with a lot of nervousness, complexity with regards to financial investments and decisions. And yet we thought it was a good moment for opportunities, to look for opportunities with quality information that we receive from our partners that are going to be with you, as they did in the previous occasions, with a winning formula to combine reasonable decisions and, emotion-based decisions. For us, it is important for the speakers to be professionals in asset managers, so they become the connecting dots. BIOS is the Best Investment Opportunities Summit, but it also makes reference to biographic curriculum, expertise of all the keynote speakers of the prominent asset managers around the world who are going to be with us today and tomorrow. The situation now has nothing to do with the situation a year ago in the first BIOS, and even on the second one, we asked ourselves, how will the markets react if there is if an effective vaccine or an effective drug? And soon after the second edition, on the 9th of November, a date we will never forget, the promising results of Pfizer's vaccine were announced, and these radically changed the picture. With a heat wave of optimism flooding companies and governments with regards to the economic recovery. The questions we need to ask ourselves now are completely different to those a year ago. Do we still have opportunities ahead after the massive rally in the markets? Do we still have opportunities ahead? Is this excess optimism or is it realistic? Who are going to be the clear winners and losers after this pandemic on the track to recovery? Will inflation change? Because with the endless amounts of money that the central banks can print, it can appear. And what do we do with the most conservative part of our portfolios? All these questions and many others that you may have will be addressed today and tomorrow. And they will be part of our keynote speakers' speeches. But if you do not find the answers to most questions, do ask us, and please be proactive. We are going to please ask you to ask as many questions as you wish to these keynote speakers, 10 of them. I would like to finish by thanking our partners, Aberdeen Standard Investments, BMO Global Asset Management, BNY Mellon Capital Group, Commoner Gestion, Fidelity International, Natixis Investment Managers, Nordea Asset Management, Schroders, and Vontobel. I would like also to take the opportunity to thank other partners who are supporting us, like EBN Bank and FPA Spain, CIAFI, and CFA Society Spain. Now begins a new edition of BIOS. Thank you very much indeed.
Hola a todos, ¿qué tal estáis? Bueno, bienvenidos.
Hello everyone, welcome. We're live streaming on this Monday, 22nd of February. It is 4 p.m. in the afternoon. It is a pleasure to be with you all once again, reviewing these investment opportunities. Let's dive into the practicalities before we listen to our experts. Antonio talked about the interaction and the surveys that you mentioned on the previous editions. What's going to be the focus of our operations? BIOS at the finect.com, where you will access our BIOS group. I have it open, and this is where you find the most relevant information. like the key players. You can follow the conferences in English and Spanish. You can choose the language you prefer. You're also going to have the agenda for this session. Today and tomorrow, we are going to begin both days at 4 p.m. As every speaker presents, we're going to upload the presentations on a separate tab, as well as articles that we have been writing, importantly for financial advisors. And this session is going to be most useful for recertification. These are credits and recertification. You're going to have the links as the sessions finish in order to fulfill these tests. And finally, information of other interest. You're also going to see that you have the possibility to take a look at the different asset managers' funds and the key ideas that are going to be mentioned today. The BIOS funds is going to be made available. And we have the platform that you can all access the funds that are going to be disclosed today at BIOS. Most of them, the contracting can be started from Finect, from this platform that eases the access to the best investment funds, where you're going to be able to contract them through different partners. One of them is EBN Bank. It is a partner of this event and really gives you the specific asset shares with no hindrances, so you can access the investment funds you're desiring with the most advantageous fees. We like innovating, and if you have been following us, you know every year there's a little bit different story. So what is it that we're going to do today? We're going to begin with the QR codes. I'm going to tell you in a minute. Before that, we're going to make a small break.
Vamos a hacer esta prueba.
Let's do this quick test with the latest QR codes. This is the latest news. We're now used to just getting the mobile phone to take a look at the menus, the QR. By the way, everyone in this room is using all the safety measures, COVID-19 measures. But anyway, the QR code, shoot it on the screen, okay? Access it. You have the address there, finect.com/BIOS, okay? If you can access, because this is the tool we are going to be using, so you can ask your questions, so we can ask you for your opinion, because both things are fundamental to us, okay? Let's go with the survey first. As you click on finect.bios, you will find information about the event. And here's where you can ask all the questions to every single asset manager. If you don't do anything, there's two questions you're going to see. Two small surveys we're going to do. First of all, in order to become acquainted with the tool, okay? And it's always a little bit more informal. And in this occasion, in order to understand what you feel, what do you intend to do on the summer holidays? What are your plans? So you've got the QR code that we're going to use afterwards so you can access the investment funds, as well as the address. We're going to ask you the first question. You've got 4 options, okay, for this test survey. The first answer is local tourism. I won't risk it until we find massive vaccination. Second option, I'll stay in my country, but I haven't checked anything yet. Third, my plan is to travel to nearby countries if possible. Or the fourth, I've already booked hotels and airplanes. Everything is back to normal. Those are the 4 options. Time to vote starts now. We want to really see what is your sentiment. How do you think the summer will evolve? Are we going to go back to the new normal? Because that's a wide variety of answers in our team. So some people had everything fully booked, and others were just waiting to see what happened with the vaccine. I'm going to receive the answers in a minute. Thank you very much, those participating. Finect.com/bios. I've received the answers. Well, the vast majority, 57%, says nearby tourism. I won't risk it until we have massive vaccination rates. And the second option is I will stay in my country. I haven't looked at anything. So we still have very little confidence on the pandemic's evolution. Let's now move on to the second survey, very much close to the market. And this is the very last one before we move on to the first keynote speaker. How do you perceive the market at the moment in terms of looking for opportunities? We're going to give you 4 options. Cheap, it's a bargain. Attractive, although less options. Third, a little bit of everything. And fourth, it is expensive, although there are still opportunities. And fifth, there is a generalized bubble. Those are the 5 options. Time to vote starts now. Let's see how you're moving around in terms of the opportunities that you perceive in the market. There are always things in the market. There's always movement, and that's what we can benefit from. So the participation is growing. Thank you very much. Well, let's take a look at the answers at the moment. The winning choice is there's a little bit of everything, okay? 41%. It's expensive, although there are opportunities. It is the option chosen by 26%. And it is attractive, but with less options. Only 11% thinks that there is a generalized bubble, yeah? But only 3% believes that the market is cheap in light of what's happened. So thank you very much for your participation. Do not close this application because we will continue asking you further questions. Without further ado, let's dive into the matter. We have our first guest, the first keynote speaker of BIOS 3.
En BMO.
At BMO, we invest with a purpose. We dare to make the difference. We help our clients accomplish their investment targets and to build a more sustainable and secure future for all. If you are an investor, an institutional investor, retail investor, or financial advisor, we will help you with your investment plan. At BMO, we make the difference. Investors may not recover the invested capital. So we will launch BIOS 3 in the Thames River in London in order to get to know Nick Henderson. Our first keynote speaker loves following and analyzing companies in order to obtain the best. Just like he does with the honey from the bees that he takes care. Let's see if applying sustainability criteria prevents him from getting the volatility dangers. Nick, thank you very much for opening this BIOS session. Thank you. Hello, Nick. The floor is yours.
Good afternoon, everyone, and thank you very much for your time today. And so what I would like to do today is talk to you about the way that we think about responsible investing and the way that we look to build that together in producing for our clients a high quality, robust, and authentic portfolio with which we invest in a responsible way. In the interest of time, I will go through how we believe responsible investing should exist within the marketplace. We have a history at BMO going back many years, which we're very proud of. But I will leave that to you to discover in time. For now, I want to think about what's happening in the future. We have at BMO a very well-resourced team, which enables us, in our belief, to produce this portfolio with real authenticity. There are many funds that are coming into sustainable and responsible investing, and we're proud to be part of that. But in order to maintain what we're doing with real authenticity and to be delivering for our clients the right portfolios, we need to have robust teams in place to deliver that. We have 3 teams with the beating heart being the global equities team, of which I am part. And then we have an incredibly well-resourced responsible investment team. You can see at the top right of the slide. And it is their responsibility to ensure that we think very deeply about all of the environmental, social, and governance risks and opportunities. For us, ESG issues are simply business risks and opportunities. If we're thinking about how a company conducts itself in its labor supply chain, or how it thinks about the potential opportunities in environmental management, these are business risks and opportunities that we want to be encapsulating and thinking about. That is why it is so important for us to have a robust team in place in order to populate the portfolio with the right companies that our investors would expect us to own. But before we get to that, I want to talk about transparency. Now, this is perhaps a logo that you know. Perhaps it is a logo that you've seen around your home. I see it everywhere, on my food packaging, on my toothpaste tube, for example. And I think I know what it means, this logo. When I look at it, I think, okay, I understand what that means. But take a pause and think, do you really know what this logo means? And we'll come back to it in a little bit later on. And I think if you haven't learned anything from what I talked to you about today, hopefully this is something that you do learn. In order to, I'll come back to that, but in order to build the portfolio that we think our investors would expect, we need to have the right teams in place. And it is only having this team structure that we genuinely deliver for our clients that which I think they want. I talked about the global equities team. We have 60 fundamental equity fund managers and analysts across the BMO network, which gives us a huge area of idea generation. We have a 21-person responsible investment team, who again delivers very strong knowledge across ESG issues. And we have a responsible investment advisory council who provides thought leadership around ESG issues. But what is it that our investors want? They want to align their investment decisions with their values. And they would like to invest in companies and with managers who can really make a change by having a collaborative conversation and engaging with the investee companies. And so we deliver a philosophy of avoid, invest, and improve, as you can see on the slide. And when we build that philosophy together, we need to find the right companies that fit into that philosophy. We look for high-quality businesses run by high-quality management teams at the right price. It is only by investing in quality that we think we can find companies that are genuinely able to capitalize upon the opportunities in front of them. So we look for competitive advantages. We look for strong sustainability. And we look at that through two lenses. One is the ESG sustainability, and I think we know what that means, thinking about labor standards, environmental standards, and so on. And secondly, we look for operational sustainability. The ability for a business to not just survive, but thrive in and around what's going on and really capitalize upon the opportunities. This is demonstrated to us by factors such as return on invested capital, return on equity, these measures of brand strength and competitive advantages. Equally, the management team is critically important. We want to find teams that can really unlock the opportunities in front of them. And of course, we have a very diligent operation around identifying the right businesses at the right prices by using a multitude of different valuation techniques. All of this valuation technique fully integrates ESG risks and opportunities. It is the very baseline of what we do, and I believe we do it well. Now, the opportunities. The world faces huge challenges. Aging demographics, climate change, urbanization. These are long-standing challenges that we need to address. As a result, we need to find companies that are right at the very forefront of addressing these challenges. Some examples are on the screen in front of you, but I'll point to one just now. There are 190 million people in India that don't have a bank account. they don't have that financial security that we take for granted. So there is a huge challenge there within the Indian society around the ability to bank safely. And HDFC Bank, in the top right, you can see there, are working within rural communities to address that challenge. And they, as a result, are seeing strong deposit growth. And that, in turn, builds strong loan growth potential for business. So they are identifying this societal challenge. They are working to address it. And that brings a circular benefit to the strength of their own business. And secondly, I will touch on one more example, which is Linde, the industrial gases business. And they are an industrial gas business providing hydrogen to enable that energy transition movement. So we have opportunities that we can invest in, align with investors' desires to allocate their capital to companies solving these challenges. But equally, we need to work with the companies we're investing in and drive improvement from an ESG perspective as to how they operate. We at BMO have a strong heritage of doing this. And it means that companies really want to listen to what we have to say. A good example is Kerry Group. This fits into the invest and the improve because Kerry Group are providing products that make our food healthier. And so they are benefiting from the trend towards healthier eating. But they're not perfect. And we have been working with them to improve how they operate. We have seen a reduction in their water intensity. And they've been training farmers within their supply chain around more conservation agriculture techniques.
Tienes un minuto, te queda un minuto de tiempo.
You only have 1 minute left.
In which these farmers can operate. And what it means for us is not only is it the right thing to do, but it feeds back into the way that we look at the business. And by reducing these risks, we feel that the company will be more profitable in the future. Back to this example. When many people look at this logo, they think that the packaging is recyclable. And many of you may be thinking the same thing. In fact, what this logo means is that that company has made a financial contribution to some recycling activity. I would argue that the toothpaste tube that sits upon, I would say that is misleading to have this logo.
Okay.
Because that toothpaste tube is not recyclable.
Nick, estamos...
And I think this is a good parallel
¿Me escuchas, Nick?
for the investment community.
¿Me escuchas, Nick?
Hello, Nick, can you hear me?
Responsible and sustainable
Can you hear me, Nick?
investment product.
Hi, Nick. Can you hear me? Can you hear me, Nick?
We need to be honest and authentic with the product that we are putting to market.
Nick, can you hear me?
Hello, Nick, can you hear me?
Try and be very transparent around the funds that we run.
Hi, Nick. Can you hear me?
So before we invest, we think about the materiality and the additionality and the intentionality of the companies with regard to sustainability. And then equally afterwards, we produce reports, as you can see on screen, to highlight the portfolio and all of its holdings and how sustainable it is. Within the chart, within that report, you will see a chart such as this on screen,
Nick?
which demonstrates the range of sustainability solutions that it provides.
Nick, estamos...
And I'll pause there for any questions.
Sí, muchas gracias. Muchas gracias, Nick. Las novedades que tenemos en esta edición de BIOS 3.
Thank you, Nick. One of the pieces of news of BIOS 3 is that we're going to be able to give the floor to professionals that can end up formulating some questions, because at the very beginning we have trouble in breaking the ice. So we've asked some people to send a video with a question, and while we wait to see the first one that they have been sent to us in this finect.com/bios, you can formulate your questions as well. But Nick, let's go with these first questions that's been formulated. This is the video made by Francisco Jiménez Marde, who is a financial advisor from MPAC. Thank you very much, and thanks to Finect for allowing me to be here. My question is the following one. Taking into consideration the assets in which your fund invests, this is an equity fund, a global equity fund, so your geographical scope of investment includes OECD countries as well as emerging countries. You're present in Taiwan, in India, etc. On the other hand, it's a responsible fund and it abides by the ESG principles. You invest only in corporations that are environmental, socially, and governance sustainable. However, in that sense, why don't you take as a reference an MSCI Adweek in order to cover the whole geographical in investment spectrum, one that will make more profitable the area, the geographical area, but also these responsible criteria that you hold very dearly. I don't know if you were able to listen to this question. The question is why you're using this reference index instead of another one that takes more into consideration emerging markets.
Pardon, in English?
Francisco asks if why the benchmark for your fund is the MSCI World and not the MSCI World version with emergings having more weight in the index.
I'm sorry, please can you repeat the question?
Yes. The question is, Francisco, this advisor, he's asking, why do you have the benchmark for the index, MSCI World, not MSCI AC World. No. No, creo que no nos escucha bien, no nos entiende bien. No. Pasamos a la siguiente pregunta.
Okay, let's go into the next question.
Is not good enough to follow you. If it could be in English, that would be great.
Sí, debemos estar teniendo algún problema en la traducción. La voy a hacer en español para que se la puedan traducir a inglés a Nick. La pregunta es, ¿por qué el benchmark del índice es el MSCI World y no la versión del índice MSCI World que tiene más peso de emergentes? Esa versión, ya que la cartera tiene emergentes en cartera.
Why aren't you including emerging?
My Spanish is not good enough.
Vamos a mover a la siguiente.
Let's move into the next question. We might be having some problems with the audio that Nick is getting because he cannot hear our question. The second question is the following one. Do you believe that Joe Biden's presidency will favor ESG and technology investments?
Will favor investments in ESG and technology?
Yes, I do. I think there is a huge opportunity for areas such as green energy and healthcare under a Biden administration. I think he recognizes the long-term challenges that the world faces. And I think, therefore, that the companies that are addressing these challenges remain very well placed for the long term.
¿Cómo? No, ¿me está escuchando ahora la traducción?
Can you hear my translation now? How do you see right now that given the weight that China is gaining in the global economy, or shall I do it in English? Nick, can you hear me in English? Can you hear me now in English? Not in English. Nick, the weight that China is gaining in the world, how could this be impacting a global portfolio from the perspective that in China they're not respecting ESG criteria when managing their corporations? How will...
Con esa traducción.
Unfortunately, we're having problem with the translation. Can you hear me now, Nick? Can you hear me? Anyway, thank you very much for your time. I'm sorry because of these technical difficulties that we're having. Apparently, you're not getting the interpretation in your office, and still, thank you for your presentation.
Thank you.
Muy bien, pues gracias a todos. Disculpad estos problemas con la traducción que hemos tenido.
Thank you, everybody. My apologies for the problems that we've had with the interpretation in the reception of your questions. We're going to start valuing this presentation. We're going to assess what you thought about this keynote speech. There you have in your mobiles finect.com/bios. There you will get a question, a survey. What do you think about this idea of investing in a global investment portfolio that it is ESG responsible as proposed by Nick Henderson by BMO? The time to vote starts now.
Ahí está. Sabéis que os estamos preguntando.
You know, we're asking you about what do you think about this investment opportunity just presented by Mr. Henderson. We have a few extra seconds for voting, and let's move into the second question. Second question is more related with his presentation, how things were explained, the presentation he gave to us, and the time to vote. Nick's presentation starts now. We know we've got this 10-second countdown. And during this presentation, you have this QR code that we're going to put on the screen for a small number of seconds so that you can answer these questions. Anyway, thank you very much for your participation, and let's move on to the second presentation. This is our second manager of our BIOS 3.
Viajamos ahora hasta la
We're traveling now till the beautiful Place Vendôme from Paris, where we have Ben Sinrak, who will see what he does in fixed income in order to find the right investment opportunity in these complex markets, although with a great harmony, because he has been singing since he was a child. He also loves practicing sports, and in July, he's going to carry out his first triathlon. We thank him for participating in this third version of BIOS. We give you now the floor.
Thank you very much. And discúlpame, voy no a hacer la presentación.
My apologies, because I cannot do the presentation in Spanish. But I promise that next time I'm going to try to do it in Spanish.
So I would like to talk to you about the fund Carmignac Portfolio Unconstrained Euro Fixed Income, which is the global flexible fixed income fund of Carmignac Gestion. This fund relies on three pillars. The first one is an active asset allocation across fixed income universe. For example, we can invest on sovereign bonds, whether they are developed or emerging, credit, whether it is investment grade, high yield, subordinated financial debt, which give us the ability to capture all the opportunities on bond markets. But also, we say that this fund is a flexible one, meaning that when we do not have strong convictions on fixed income markets, we can diminish the exposure, decrease the exposure to fixed income markets, and so protect the performance of the fund. The second pillar of this fund is that we have a dynamic approach of the modified duration, meaning of the exposure to interest risk. As you can see, our room of maneuver is very large, from -3 to +8, meaning that when we have strong conviction on fixed income markets, we can implement them and have a very large, very important modified duration. But at the same time, when we fear about higher interest rates, we can go to negative territory on the global duration of the fund. And in the end, as you can see, those two pillars are top-down pillar, meaning that they rely on the fundamentals of macroeconomy, on central bank monetary policy. And we have a third pillar, which is the bottom-up approach. And in this fund, we work closely with all our experts on fixed income markets, and we delegate them the buckets of investments, for example, on credit or on EM markets, and they will do the bond picking, meaning that they will extract the best of the convictions of the Carmignac team specialists. Maybe a few words about our track record since we joined Carmignac, because maybe as you know, Guillaume Rijad and myself, who are the two co-managers of this fund, we have been working together for the past 8 years, and we've joined Carmignac on July 9th, 2019. And since then, the performance has been also really important. As you can see, we generated more than 10% of performance since July 9th, 2019, while at the same time, fixed income markets, illustrated by our reference indicator, only generated a little bit more than 1%. And if we do a focus on 2020, last year, the performance of the fund has been more than 9%, while beating more than 97% of our peers, and putting the fund, so Carmignac Portfolio Unconstrained Euro Fixed Income, in the first decile of its Morningstar category. So we've said that we are active and flexible, and I would like to show you how we are active and flexible on the exposure to interest risk, but also on the asset allocation. As you can see here is the average modified duration, so the average exposure to the interest rate risk in the fund since the beginning of the year 2020. When the COVID arrived in Europe, we raised the modified duration close to the maximum levels that we can have in the fund, as you can see, up to 7.5 years of duration. And we kept this until July or August 2020, in that phase where central banks were saying that rates will be lower for longer. When markets and economy started to open, we decided to lower the average modified duration, as economies were not needing such a support, and maybe we'll have some pressure on the inflation side. And since the beginning of the year, as we've seen the turning point with the Senate, the US Senate going from Republicans to Democrats, meaning that the US administration will be able to spend and to offer far more fiscal policy than it was able in 2020 under Trump, or under Trump administration versus a Republican Senate. So we've said that this was maybe a very turning point, and that's why you can see that the modified duration has been lowered from 7 to a range between 3 and 4. So this means that we have been really active and continue to be active on the exposure to the interest rate risk. At the same time, here in those two graphs, you can see on the left-hand side that we are also very active on the net exposure to fixed income segments. For example, in March 2020, where the correction was very tough on fixed income markets, our exposure to fixed income markets in the fund was declined to 40%. So it was like we had 60% of cash and money market papers at that time. And even as you can see on the other graph, we had at that time a negative exposure to high yield credit. And we show that we are active and dynamic, because when we had the conviction that central banks will do whatever it takes in order to save the economies, helped also by fiscal authorities, what we have done is that we have increased the exposure of various asset classes, various fixed income asset classes in the fund. And what is interesting is that we not only raised the credit, for example, investment grade or high yield, but what we have done, as you can see, is that we have also increased a lot inflation in the fund. Because when we were all into lockdown in March, April of last year, markets were expecting that inflation expectations will be close to zero for the next 10 years. And even if we were convinced that the hit to economies will be very important and very tough to cope, we were thinking that inflation will not be at zero for the next 10 years. And that's why, as you can see, we've built large position on inflation expectations. And since the beginning of the year, to the contrary, we've been a little bit more cautious, but I will highlight this a little bit after. So now, what are our convictions on fixed income markets? We think that market, if we look at the global risk on credit, for example, we think that a lot of good news is already priced and that markets are a bit expensive. That's why we do not favor the beta of the asset class, but we prefer the alpha, meaning that we will highlight some themes, some thematics in the fund where we will allocate some capital. And these thematics are here on page 6 of the presentation via the name reopening theme. We are long on oil and gas companies like Pemex or Gazprom, for example, and also on some airline companies, automotive or tourism, like the company Carnival, for example, or EasyJet. Why we are positive on those companies? Because fundamentals are quite good. Those companies were well managed before the pandemic, and so they are able to pass and to cope with this pandemic. Valuations are very, very attractive, far more attractive than on the beta of the asset class. And we think, to the contrary, that the beta, I will say, the usual suspects in the credit markets are a bit expensive, and that's why we'll buy some protections against the beta of the asset class. So that's for credit, where our main conviction will be on reopening. The second thematic where we are really comfortable and really invested in is on subordinated financial debt. One big difference from the 2008 crisis and the 2020 COVID-19 pandemic is that in 2008, banks were not associated at all to the recovery, and even to the contrary, as we all remember, Lehman Brothers went to bankruptcy, etc. Now, central banks and fiscal authorities have understood that in order to promote the recovery, we need strong banks. And that's why all the different measures that have been implemented since the start of the pandemic was also in order to make banks firm and important to play the transmission channel. That's why we are positive on the subordinated financial debt, but also because we have long-term factors, as shown on the first graph, which shows that now there is no problem of solvency in European banks. And as you can see on the second graph, we have valuations that are really attractive, far more attractive than on the corporate credit. And that's why we are a long position, 11% of the fund exposed to financial debt. And on this, we will rely on national champions in Italy, in Spain, in France, like UniCredit, BBVA, BNP Paribas, or Intesa Sanpaolo. We cannot talk about a fixed income fund without talking about our stance on the modified duration. And on this, as you can see, we have taken different approach in order to express the reflationary environment that we are in since the beginning of the year. First, our first action, as you can see on the left-hand side of the page 8, we have decreased quite meaningfully our exposure to the long end part of the different yield curves. While it was standing at 400 basis points in September or October, now stands at 200 basis points. We have also highlighted the main yield curves that will respond to inflationary pressure. As you can see, we have built some negative duration position on some Eastern European countries like Czech Republic, Hungary, or Poland, where inflation is already at the target of the central bank and where we are seeing some inflationary pressure. And on this, for example, since the beginning of the year, even if, for example, US rates climbed by 30 to 40 basis points, in some countries, like, for example, in Poland, 5-year Polish rate rose by 60 to 80 basis points. We have also expressed a negative view on the Norwegian yield curve, where also because of the rise of oil prices over the last 6 months, we've been seeing some inflationary pressures in Norway, and also the central bank changing its stance about very low rates. And so it means that the global duration risk of the fund has really decreased from 6 to a range between 3 and 4. And finally, before going and having your questions, you can see here the exact positioning of the fund with the duration. So it's at 370 basis points. The total credit standing at 43%, with a split between corporate bonds and financial debt, and the total government debt at 43%, with 31% of developed markets sovereign debt and 12% of EM markets. And I would like also to highlight the fact that we are still positive on inflation expectations, and especially in the US, where we think that this new approach of the central bank, the flexible average inflation targeting, meaning that the Fed wants higher inflation in the US before considering the raise of interest rates. So that's why we are positive on inflation expectations, and so we think that it will continue to have an impact in the US. So I'm done with the presentation, and I'm really keen to receive your questions. Thank you very much.
Muchas gracias, Eliezer.
Thank you very much. As you saw, we have a QR code there that you can capture so you can see throughout the presentation all of the information. We have a question that was formulated by an advisor, Hector Perez, by Core Capital AF, and we're going to see the video with his questions. Hello. Thank you very much for your presentation, and congratulations for your results and for the evolution of the fund. I was taking a look at your presentation, and I saw that most of the presentation had to do with your inflation strategies. Although it is true that from mid last year until now, the percentage of the fund that has to do with this strategy has been reduced, has decreased. It seems like in your presentation in 2021, these strategies will take a dominant part. And what I would like to know about your inflation strategies is the separation that you do in geographical areas. Do you think that there's going to be a greater increase of inflation in Europe, in the United States, or in other geographical areas? Thank you.
Thank you very much, Hector, for your question. I will try to be really clear on this one, as it is really an important one. Actually, we've been really active on inflation since, as you can see on maybe on the page 5 of the presentation. I don't know if we can have the presentation on the screen.
Listen.
But as you can see, as you will see on the presentation, in March we decided, when real interest rates in the US went positive, we decided to buy US TIPS, so US bonds linked to inflation. And actually, we kept this position until July 2020. We also, during that time, decided to invest also in European inflation because we were thinking that also European inflation was too low and expectations was too low compared to the different base effects that we will have. So we had this position on European inflation until the beginning of the year, and with the different surprise that we have seen in all the different inflation prints in Europe. We decided to take profit on our European inflation, break-even inflation, because we think that the central bank will have some trouble to reignite, to increase inflation expectations in Europe. But we are still convinced that in the US, with the fact that fiscal package will be important, we'll have the first fiscal package maybe voted in the next 2 to 3 weeks. And we expect also a next package, an infrastructure package for the coming, for example, in May or June. And so it will have also some positive impact on inflation expectations. So that's why today, in order to answer your question, we are positive on the US inflation and not anymore on European inflation, where in the next 2 to 6 months, we'll have negative surprises.
Eliezer, tenemos otra pregunta. Dice...
We have another question. Let's see if you can get the sound now. Can you hear me now? Can you hear me? Okay, perfect. So we have this question of an Asian fixed income. Is the Chinese bond the best possible investment this year?
We have a small position. That's why I didn't talk about it, because it's a small one. Actually, the highest real yield in the world is in China, because rates are at 3% and inflation is quite low. So we have a real yield at 3%. So in a way, it's an opportunity. But at the same time, China, as we all know, has been the main beneficiary of the COVID-19 pandemic. And so the rebound that we've seen in China is really important. So, and the PBOC, so the central bank of China, is also trying to remove some liquidity. So it put also some pressure on interest rates in China. But we think at Carmignac that it's a good position in order to protect a portfolio. It will be a good hedge, for example, to a long equity position or to a long risk position, because if there is a deceleration of the Chinese growth, interest rates will decline meaningfully.
Eliezer, we just got another question. How will the Chinese inclusion in the benchmark of JP Morgan emerging market with an important weight?
It will have. It has some impact, attracting flows for sure. But in the end, for benchmark funds, I think that it's important. But for unconstrained approach, like we have, for example, it does not change a lot, because the spread on Chinese bond is already quite low. And so when you are buying Chinese government bond, it's more a duration view rather than a spread view. And so we don't think that it will have a great impact having it on the JP Morgan index.
Más sobre escenarios
One more question about possible scenarios that we can find ourselves. The first one, what will happen in your portfolio as if it was a stress test if there was an interest rate increase of the European Central Bank of 0.25%?
A rise in interest rates?
¿Qué efecto tendría la cartera?
Yeah, what will be the impact in your portfolio? Yeah, what will be the impact in your portfolio if there was a raise of the interest rate?
Beginning of the year, as I was saying, the core rates, so in Europe or in the US, rates went up by 30 to 50 basis points. And what is interesting is that our reference index illustrating global fixed income markets declined by 160 basis points, while our fund, Carmignac Portfolio Unconstrained Euro Fixed Income, is positive and posting a performance of 25 basis points. So we think that in this environment, we can have rise in interest rates, but we think that the portfolio for the moment is well prepared for this.
Preguntan también qué pasaría.
The other question is, what will happen? How will your scenario change if the new strains of COVID virus were to expand?
I think that we all have now the tools in order to live with the virus. Live with the virus in the street means that you wear a mask. But live with the virus in the financial world means that the central bank is expanding its quantitative easing, that fiscal authorities are expanding their help. So we don't think that it will have a major impact for developed economies. I think that it will have some important impact for emerging market economies. Because what is interesting is that during the COVID-19 crisis, all the economies applied the same recipe, meaning putting interest rates at zero and implementing non-conventional monetary policy, so meaning quantitative easing. And I think that when you are at the Fed or at the ECB, it's possible to have it in sustainable during many months. But when you are a smaller central bank, I think that it's far more difficult to keep buying and to keep interest rate at zero.
Y la última está.
And the final one, this is my own questions. How does it change for a portfolio manager in a position like the Italian bonds, the fact that the new prime minister, the new person in charge of Italian policy is the last manager of the ECB? Does this make you feel more that the Italian bonds are more trustworthy or not?
Increase a lot the trust in Italy. But I think that the best way to express this conviction will be to have banks in the portfolio, and especially Italian banks. Because as you can see, the 10-year Italian bond is at 50 or 60 basis points. Maybe the spread can tighten by 10 to 15 basis points. But I think that where there is still some value is on banks, and especially Italian banks, and that's why to have Draghi was also the supervisory of banks. I think that it's really helpful for Italian banks.
Pues muchísimas gracias por tu tiempo.
Thank you very much for taking your time to be with us. It's been a pleasure having you with us.
Vamos a seguir adelante. Primero, ya sabéis, sacar esta aplicación.
Just get that up, finect.com/bios, and capture it with the QR code, because we're going to launch these 2 questions in order to rate this presentation of Eliezer. The first question is, what did you think about this investment idea put forward by Eliezer? Time to vote starts now. Joint manager of Carmignac for these fixed income opportunities globally. And the second question is, what did you think about the way he presented and the answers to the questions he has put forward? The time starts now. Thank you. 5 or less. This is very interesting for us in order to know the type of ideas that you like the most. Thank you very much for voting. Thank you very much. Let's now move on. We are about to reach the equator of this session with the third presentation for the day. We're back on our journey. We're going to go to London, where we find ourselves with the Susan Hutchins. She's very proud grandma of 4 grandchildren, trying to secure positive returns in any environment, but with a sustainability approach. She is fascinated about it. This is one of her passions. So thank you very much, Susan. Welcome. Thank you very much, Susan. The time is yours.
Hi there. Thank you very much for joining Sustainable Investing, Drama or Reality. As we go through the presentation today, I would like to introduce you to a world in transition. We obviously live in a very complex, interconnected ecosystem, and we really need to understand the trends when we're allocating our clients' capital. As you can see from here, all of these trends in nature will influence our macro and our micro decisions, both at a top-down asset allocation level and a bottom-up security selection level. In fact, climate action failure or climate action change, Spain is one of the top 10 countries to acknowledge that this is one of the major financial risks. And obviously, Madrid's just been through one of the worst winters for 50 years. So extreme weather is also important to think about. And post-COVID, infectious diseases, I'm sure, will become a much larger red dot in the World Economic Forum as the risk report comes out next year. So environmental and social issues were once thought of as non-financial information, and that really is a misnomer. All of these issues, whether it's environmental, social capital, human capital, business model and innovation, as well as leadership and governance, will impact the financial returns of any investment. And it's very, very important to understand how this mosaic of risks fit together when you're analysing an individual company or security, as well as considering all of the other financial risks associated with that security. So it's integral to investing on a sustainable basis. if we think about the three vectors of sustainable investment, the tension between the social consequences and the environmental impacts really resonates with what is about generating financial returns. And to be successful at it as a business, you need to be able to combine all three. And businesses that manage all of these tensions together will ultimately be sustainable and resilient over the longer term. And when you think about it, the likes of Kraft Heinz is very much anchored in the past, whereas if you take a company, for example, like Unilever, that is really transitioning from using all of the solution providers to generating a better return stream and better products, both on a nutritional basis and a social and economic basis as well. In fact, the environment is changing so fast that in Spain, for example, the use of coal has fallen by nearly 86% since 2002, and nearly 40% of your electricity generation is now coming from renewable energy. So when we're thinking about opportunities at a bottom-up basis, there are really four areas of focus. You can think about the solution providers. So that would be some of the obvious examples like wind, renewable energy, companies like Ecolab, for example, and testing and service companies. But it isn't just about the solution providers, because in that space, as you well know, a company like Orsted has become a very, very expensive stock. It's up 41% over the last 3 years. But, it's very much benefited from the trend towards sustainability angle. And we need to think about more fully integrating all of the other areas of focus. So thinking about balancing stakeholders, for example, both combining social and environmental factors, whether that's companies, for example, that I've suggested, like Unilever, or indeed it's about identifying opportunities like Kerry Group, for example, which is a food and nutrition business, which is really focusing on the health of the stakeholder, the customer, as well as thinking about balancing environmental needs as well. There's also those sorts of companies that are in transition. And as a fully integrated ESG proposition, we can think about carbon fuel companies that are making that transition. And Shell would be one of those that would be in transition. But in the sustainable approach that we adopt at Newton, there are certain areas, certain companies that are actually prohibited from investment, particularly if they don't meet the criteria or the red lines. And some of those red lines would be about avoiding market failures. And what we mean by that is businesses that inherent through the type of business that they're in, whether it's tobacco or pornography or even carbon fuels, they may not meet or do not meet the UN Global Compact, and nor do they meet the red lines that we have in our sustainable funds, whereby businesses have to sign up to the Paris Accord and meet the CO2 obligations. So it's investing in companies that are progressive, and it's taking our approach at Newton, which fully integrates environmental and social governance issues, into a more progressive approach around sustainability. And sustainability and themes are integral to the way in which we think about identifying the universe of opportunities, both from a macro level, thinking about themes in terms of state intervention, as well as inflation risks around fire hazards. But also it's about identifying and reducing the universe to a smaller refined set to really focus on the structural drivers to the longer term. So what we don't do is try to make forecasts which are inherently unstable, and most economists get them wrong. What we're trying to use is a framework where it's identifiable observations and it's not based on a backward-looking quantitative model. So it's important that this approach is very much forward-looking and based on the long-term objectives of our clients, as well as how we think about investing. So what are the portfolio characteristics and performance? So the Sustainable Euro Real Return Fund has been around for now over a year, and it's based upon our real return strategy that was launched 16 years ago. So what is it? It's unconstrained, it's multi-asset. It has a benchmark, which is a cash plus benchmark of Euribor, soon to be Estor, plus 4% annualized. And we seek to deliver our returns through three main objectives. One is the stock selection, the security selection, using the sustainable lens, which I've talked about. It's the asset type flexibility, and this flexibility, as we have referred to in the dynamic, interconnected world, makes this solution so relevant to the changes in the themes and trends that we're observing, but also the massive change that is going on in the macro backdrop with monetary MMT, modern monetary theory, with both a monetary and fiscal response to the environment. And then there's a real balance of trying to emphasize capital preservation. So it's about growing our clients' wealth, but also helping to preserve capital. And in the next slide, you'll see here, this is the long-term results of the Sterling Fund, which goes back to 2004. So the blue line is the fund return. And over 1, 3, and 5 years, you can see that we've beaten the objective of LIBOR plus 4 by generating a return of 7.8%, 7%, and 5.8% respectively. If you look at the annualized return of the strategy over the longer term, the dark blue lines, you will see that we've never made a negative calendar year gross of fees. And you can also see that in market drawdowns, this is showing you the sustainable real return strategy where the Sterling Fund was launched in 2018. We've actually managed to really mitigate market drawdowns by only having a drawdown capture of 10% in Q4 2018. And whilst having a larger drawdown capture in Q1 of last year, because of the liquidity shock, we actually very quickly managed to recapture our returns over that period. So we are generating over the longer term, and this goes back to the strategy in sterling terms, we are generating about that of the market, 7.7% on the long-term basis versus 7.9% for the market, with half that of the market volatility. So very decent risk-adjusted returns. So the way that we think about conceptually building the portfolio, it's a tire-based approach. It's a single portfolio approach of two portions, both a single return-seeking core, that's the inner core, and an outer layer, a tie, which is a stabilizing layer. And you can see that all of the assets there you'll be familiar with, whether it's equities, EMD, corporate debt, alternatives. And we stabilize that core with the use of derivatives to help protect the portfolio on the downside, but also to risk the portfolio on the upside if we're feel like we're being too conservative. You'll also see in the stabilizing there are things like gold as well as government bonds. But actually government bonds is an area that we're looking to exit as we go into the new MMT environment. So the size of the core and the outer layer will change. And the reason why we like it to retire is when the going's good and you're getting paid to take risk, you don't want to have too much in your stabilizing layer, and you want a very fat return-seeking core. But when the going's tough and there's lots of risks and uncertainty out there, then you want a big stabilizing layer. And I would describe that very much like a tractor tire. So I spoke very briefly about our view about the backdrop, and we strongly believe at Newton that we are in a new regime shift where it's gone from 10 years of deflation to one of inflation or reflation. And that's very much driven by policy response. And the catalyst has really been COVID. That's been the accelerator of change, both through sustainability and the forces of climate change and focus on the social and governance impact of businesses, but then also on the structural change that we're seeing through MMT. So in terms of the portfolio positioning, which I say is very dynamic, as at the end of January, we had 59% in that return-seeking core and 40% in the stabilizing layer. Now, that return-seeking core has been as much as 95% and as little as 25%. So you can see there that we are more constructive about the backdrop right now, but we've also got a lot of stabilizing positions in the portfolio to help hedge from a tail risk event. You'll see there that net equity exposure is around about 31%, with some of the largest positions in the sustainable funds within the equity space being companies like the industrial gas business Linde. We've got a big position in AIA, the insurer, HDFC, which is really promoting digital currency transactions for all those people in India that don't necessarily have a cash balance sheet or bank to go to. Companies like Continental, T Connectivity, and Greencoat UK Winds, to be just a few examples. You can also see that in the previous slide, we had quite a lot of exposure to alternatives, which includes things like renewables and energy. And in the pie, we also had quite a significant exposure to cash, but very little duration exposure in the portfolio. You'll see there, that's the return-seeking core. The diamond is where we are today. So just lastly, turning to the process and allocation, given that this is a multi-asset portfolio, it's very important to understand that there are lots of people involved in the selection of securities. We run very much a team-based approach at Newton, and clients access our responsible investment team, where we are leaders in sustainability, with Andrew Parry leading our sustainable approach. There are 9 of us on the team. We've been managing the strategy for 16 years, and the sustainable real return strategy is very much based around the principles of our core integrated ESG strategy. So we have the benefit of having a deep resource of research that are generating the bottom-up ideas, as well as the longevity in our expertise in sustainable investing and ESG integrated investing, which goes back over 30 years. You'll see there, this is the process by which we put together the stocks. So you've got the red lines, you've got the sustainable themes that I spoke about, and then you've got the process by which we identify those stocks to go into the portfolio. And then we risk manage that portfolio to ensure that it meets the objective of LIBOR +4 with capital preservation. The next slide just gives you an example of T Connectivity, which is one of the largest holdings in the portfolio. And I will leave you to review that security, which really meets our sustainable needs in the strategy. So last but by no means least, we've got a very long proven track record in generating risk-adjusted returns and those that meet our sustainable regime, which we think is most relevant to the environment that we're investing in now. We're very active owners. This portfolio makes bold decisions. It doesn't use leverage, i.e. it doesn't borrow at the fund level. We're never over-invested. It's very liquid. It's very transparent. And we put our money where our mouth is. And we score very, very highly as well in terms of how we report our ESG and sustainable considerations. Mm-hmm. So without further ado, thank you very much for listening to my presentation, and I'll turn it back to the coordinator. Thank you very much.
Muchísimas.
Thank you very much, Suzanne. We're going to ask a question that we have received by a financial advisor, as the ones that you can find on the advisors platform. And in this case, we are going to listen to Pere Fonsimon from AXA Exclusive. Good morning. We have a challenge ahead of us, the decarbonization of the planet ahead of 2050. You know that there's been an eruption of new technologies with the use of green hydrogen. I would like to ask you, is this technology here to stay, or is this going to be an efficient technology, cost-efficient technology? Thank you very much indeed.
Susan, ¿has escuchado la...
Susan, did you hear the question?
Perfecto. ¿Qué te parece esa?
What did you think of that transition? Did you hear the question, Susan?
Ese reto que tenemos.
Let's try and fix this problem. But I'm going to try and ask you the question. The challenge that we have ahead of 2050, the decarbonization of the planet, what do you think of it? And what are the opportunities behind it? And also related to the great, yes.
No.
Again, I'm sorry, I don't speak Spanish, so I can't understand the question.
Susan,
I do apologize.
Maybe in English. Is the challenge that we have for 2050 for the decarbonization of the planet? How is that in terms of how you construct your portfolio, in terms of the opportunities you see?
Sorry, I couldn't hear you. I'm sorry. Could you repeat the question in English, please?
Yep. Vamos a intentar hacerlo en inglés de nuevo. Es como la pregunta que nos hacía Pere era the 2050 challenge of decarbonization.
Yeah.
How does impact your portfolio and the ideas that you are introducing in your portfolio are affected by this tremendous challenge?
Mm-hmm. Okay, thank you for the question. Yes, I mean, we're thinking about this climate change challenge considerably, and we are already preparing the portfolio and our client sets for the benefits of this move to net zero carbon. And so many of the investments in the portfolio have got very clean energy, and we're investing in businesses that have clean technology. We've got a lot of exposure to renewables and solar, for example, and wind. And also, there's areas where we're not invested. So we don't invest in carbon or fossil fuel businesses, for example. So it very much is focusing on the structural growth opportunities that the climate change policy plan, the Paris Accord, will align our clients and the portfolio too.
Te la sigo haciendo en inglés. What? In inglés? Susan, the next question is about the impact of the Biden presidents of the US.
Sure. I mean, I think that's going to be really positive. The fact that the US have signed up to the Paris Accord as of this weekend will mean that the whole of the move towards climate change being about borders and also about imports and exports and the types of goods that are sold will just embellish the opportunity set for and accelerate the move towards a better environment on every level, actually. So Biden has been absolutely brilliant in promoting this, and a number of his plans in the US involve a lot of infrastructure build out, social energy, green energy, the sorts of social funding, again, that will be beneficial for the types of investments that we look to seek in the portfolio.
What differentiates the most your fund in regard to other sustainable funds?
Yep.
Which is the main difference between your?
Well, I would suggest there's a lot of. I mean, the competition's far and wide, and we the way that we invest is very much bottom-up, research-driven. We have our own environmental, social and governance and responsible investment team that analyse every single security in the portfolio. We do thorough due diligence. We have only 40 stocks, for example, in the portfolio, or even with other asset classes. We do our due diligence very much from the bottom up. And it's unfortunate in this market, there's a lot of asset managers that say they do sustainability, but they do it very much at a superficial level and just use outside providers or Sustainalytics or MSCI, where you really need to get into the weeds of every single company to be able to really understand what you're owning and the financial impacts to that. And it's not a question of screening out companies, because there are many companies that are transitioning to a better sustainable environment. And you can only capture that by doing your own research and due diligence. And that's where we have a huge amount of resource at Newton, at BNY, to be able to do that level of due diligence and improve the financial returns for our clients.
Are you investing in the biotech sector in the portfolio?
Sorry?
Are you investing in the biotech sector in portfolio? Biotech.
Biotech. We actually haven't got biotech per se. We do lend to a biotech company, which through biotech companies usually go to big pharma businesses to get their lending or get bought out. But we've got a biotech business in the portfolio where we've lent to them to improve the return profile on that investment. So biotech and healthcare is an area that we're very attracted to, really because of the sustainability and thematic angle of demographics and aging population, and the need, obviously, to find solutions for these diseases that we're being faced with today.
Muchísimas gracias, Susan.
Thank you very much, Susan, for your time this evening and for answering our questions.
This evening.
Thank you.
Thank you very much.
I'm sorry I don't speak Spanish.
Sorry about that. It's a problem, difficulties that we're having with the translation wire to you. So sorry about that. Thank you. Thank you, Susan. Vamos a pasar a valorar esta presentación.
So now we're going to evaluate this presentation. First question, finect.com/bios. And the first question is, what do you think about this investment idea of this BNY Mellon investment fund focusing on socially responsible assets? And the time to vote starts now. You have there the QR code as well as the address of the URL address of the application so that you can vote.
De la presentación que os ha hecho Susan. Muchísimas gracias. Y ahora vamos a ir inmediatamente.
And now we're immediately going to go into the second of the ideas in this case, in this survey, how you evaluate Susan Hutchins' presentation, and the time to vote starts now. We sincerely appreciate your participation, despite the technical problems that we're having with the translation. Hopefully, we will be able to fix it in the next presentation. While the speaker is talking, we give you the QR code so that you can get access to the information about those funds that are being presented at finect.com. And let's start now with the fourth intervention of this day, of this BIOS day.
Seguimos en Londres. Vamos a conectar ahora con Jessica.
We're still in London, and now we're going to connect with Jessica Redder. In the Shredder, since 2011, they think that in order to fight the big challenge of climate change, it is absolutely necessary to foster the transition toward clean energy through our investments. But not only that, they go down to earth, as in 2019, when she spent a period of time in the Amazon collaborating in preservation processes. In projects. Thank you. Now you have the floor.
Again, here, I don't speak any Spanish, so please forgive me. I will have to speak in English if that's okay.
Yes, of course. Thank you.
Yes, please go ahead.
Yes, of course. Thank you. Please go ahead.
Great. Hello, everyone, and a very warm welcome, and thank you for your time today. Are you happy for me to start?
Yeah. Yeah, please go ahead. Thank you.
Great. So we have some slides here on the desk. About 3 years ago, clients came to us and they wanted a fund which offered exposure to the pure play companies with no fossil fuel exposure across the entire value chain up to the plug socket. That's exactly what we do on this fund. We invest in companies that are directly involved and that are actively contributing to the transition to a more sustainable energy system. And in line with what we said when we first launched the fund, we would see this huge wave of investment into the sector because what we're going through is not a cyclical shift in the energy transition. It's very much a structural shift in the energy transition. It's something that happens once every 70 years. It's not a 1-year theme or a 2-year theme or a 5-year theme, but it is literally a multi-decade investment theme. The weight of investment that's going into the sector is absolutely huge. $100 trillion is the best number to remember on this between now and 2050. What you will see on this slide is what's effectively driving this is global emissions. And global emissions on the current run rate we're on ignoring this year because of COVID and ignoring last year because of COVID, they're effectively increasing at a rate that puts us at 3.7 degrees increase in temperatures by the time we get to 2100. But the number we like to focus on in order to get back to the 2-degree path, which was agreed in Paris, that everyone talks about, we essentially need to reduce carbon emissions by 33% between now and 2030. So there's certainly a near-term impact that needs to come through. On the next slide, what you will see is COVID has obviously impacted all of our lives. It certainly hasn't derailed the theme. Investment rates have not slowed. In fact, they have increased. So everything in black on this slide were policies globally with regard to changing the energy system. And everything in red has been announced this year and last year as a result of COVID. You've seen the Euro Recovery Fund, which was already tabled in the Green Deal in November. But what we've seen is because of the stimulus that's been proposed as a result of COVID, a lot of that is being redirected into hydrogen, renewables, and electrical infrastructure. China has come out with a $2 trillion package. We've seen net zero targets from them, from Korea, from Japan. So it's a really exciting time. And of course, you've got $2 trillion into clean energy with the win of Biden as well. So that is a real game changer. On the next slide, what you will see on slide 3, on the left-hand side shows the official green stimulus approved by End Market. And you can see a lot is going into electrical transport, into hydrogen. And this is only approved direct green stimulus related to COVID. So this doesn't include the broader Green Deal packages. The chart in the middle, we've tried to split this out in terms of size. You have the broader EU green proposal, the Biden proposal, which is absolutely massive. And this doesn't include anything to do with China either. The amount of investment that's going to be put into the space is absolutely huge. Now, on the right-hand side, what you will see is another part of the industry that's actually having to change massively. And that is the integrated large-cap oil companies that need to reduce their conventional oil and gas capex. That's exactly what they're doing. And they're increasing their green energy capex. For example, BP have completely changed their business model. What you'll see on this slide is the drivers causing this structural shift. Now, there are 3 really simple but very, very powerful drivers. Sometimes you have government policy basically driving a theme. Sometimes you have consumer trends. But here we have government policy, consumer trends, and environmental impact influencing the structural shift. And in addition, we've got the weight of investment as well. On the first driver, what you can see is the decarbonization of power generation. The share of electricity generated from renewables between now and 2050 is expected to increase from 20% closer to 85% by 2050. So a 4-fold increase. And this is a huge, huge increase given our starting point. Only a few years ago, we were at less than 10%. Secondly, you've got the way we consume energy, which is going to change massively as well. It is going to add to the infrastructure spend. It's going to add to the electricity generation as well. Because most of the energy that we're consuming now, it comes from, the gas that we use to heat our homes, but also from the fuel that we put in our car that basically uses far more energy than we use at home. So if we have one electric vehicle and drive that 8,000 miles a year, we use the same amount of electricity as an entire household of 4 people for a year. And lastly, because you can't physically deliver that level of energy, on the other side of the coin, to try and offset this, there are a number of technologies that are trying to reduce the energy intensity, and that's what we invest in the fund as well. On the next slide, slide 5, what we will see is how many times this transition has occurred in the past. On the left-hand side, you have this chart that shows you that this structural shift has occurred twice in the last 170 years. Firstly, we had the introduction of coal, which essentially replaced traditional biofuels. But the coal acceleration occurred not just from the personal usage in our homes, but also from transportation, which was a big driver of coal usage. And that took 100 years for coal to effectively get to 50% of the energy mix. Then oil and gas, and then oil in particular, that took about 70 years to effectively get to 50% of the energy mix. The only thing that we can compare this to historically is the growth in digital. Now, renewables has been around for a long, long time, since the 1900s in the form of hydropower, but it's really since the 2100s that renewables in the form of solar and wind have really been introduced. And over a decade, we've jumped to 10% of overall usage, which is unbelievable growth rate between now and 2050. And that number is going to increase massively over the next 30 years. So across a number of different sectors, whether that be EV sales, stationary storage, inverters, you're going to see massive growth as well. On the next slide, on slide 6, the reason that this is happening now, and it wasn't happening when we go back to 2010, 2015, even though renewables were around, was because at the time, renewables were not economically viable. Now, if you look at the levelized cost of energy for renewables, it competes comfortably with combined cycle gas turbines and coal. And this is very, very important because this slide shows you where we're going as much as where we've come from. And you can see on the right-hand side that there are lots of deadlines fast approaching to phase out the internal combustion engine, like the UK, Canada, in 2040, Norway, the internal combustion phase out is 2025. So a huge amount of electricity will be needed and the infrastructure will be needed to be put in place to enable this change. On the next slide, what you will see on slide 7 is if you look at the solar PV efficiency gains every year, we've been increasing efficiency gains of solar by about 28% per annum. Now, it won't continue at this rate. We've been speaking to companies like Dayco, Zingy Glass. They all operate in the solar industry, and they're still targeting about 20 to 25% efficiency gains over the next 2 years. Then if we look at offshore and onshore wind, the turbine sizes, when wind turbines were originally put in place, were 2 megawatt turbines. Like a GE, Vestas, Siemens, they're all essentially looking to install 15, 20 megawatt turbines in offshore farms. This is important because what you've done is you've effectively increased the efficiency of these turbines by about 6-fold overnight. And the chart on the right-hand side shows you this is the real game changer, lithium-ion batteries using 811 technology. They have never been more cost competitive than they are now. So the costs have come down to just $100 per kilowatt hour from $1,200 per kilowatt hour. And this is cost break even with an internal combustion engine. So for a VW, for a BMW, Mercedes, for their platforms now, it makes sense to start installing battery packs versus an internal combustion engine. On the next slide, what you will see, it gives you a sense of what our fund does. Our fund invests across the entire value chain of the energy transition. And the reason we have to invest across the entire value chain because literally everything is being upgraded. Now, clean energy generation is a really important part of it in terms of providing not only renewable equipment themselves, so the wind turbines, the solar panels, but also components to that. So the blades to the turbines, the composite materials for the blades, the polysilicon and the glass for the modules, etc. But equally important is upgrading the transmission and distribution networks to make the grid more robust. The whole of Germany, for example, is being upgraded in terms of transmission and distribution networks to remove themselves from lignite coal. You also have storage facilities, charging infrastructure, component manufacturers like Legrand and Schneider who are part of this fund. So the way to think about this fund is we invest in everything from renewable power generation all the way to the plug socket. We exclude fossil fuels and nuclear power from this fund. On the next slide, what this shows you is the opportunity set. The investment opportunity has to come back to the market capitalization of the sector relative to the investment rates. Now, the investment rates have started to increase and they're going to accelerate from here. I cannot stress enough that this is a multi-decade investment theme. It's not a 5-minute investment theme. At the moment, the market cap of the subsectors that we are positioning the portfolio against are relatively small to the investment rates, and that's clearly the investment opportunity. On the next slide, on slide 11, what we really wanted to do when we thought about the universe is make sure we were offering clients a pure play product and capturing opportunities across the entire value chain. So on the left-hand side, you will see the universe splits across the 5 categories, the energy transition categories. And you can see it's a really nice spread out mix. What's interesting is when we looked at the passive alternatives in this space, And why I think an active approach is particularly helpful is because passive indices are heavily weighted to just one part of the energy transition. So the light blue circle, if we can just go back a couple of slides, please. Yeah, just that one. Yeah, perfect. Thank you. The light blue circle on the right-hand side, again, it shows you the energy transition sector is less than 1% of the entire global market. Now, energy has been running at around 7 to 8% through cycle as a percentage of the ACWI over the last 3 decades. Now, fossil fuel has made up a huge amount of that coupled with utilities, but that is the obvious shrinking. Fossil fuels has shrunk to less than 3% of the S&P 500, for example. And this is going to be replaced by the new sector, which will not stay at less than 1% of the ACWI on a long-term basis, given the investment rates. Now, if we look at the next slide, which is the investment process slide, it just shows you what we're trying to do on this fund. So we invest in companies that are directly involved and that are actively contributing to the sustainable energy system. This provides an overview of the investment process. And if you focus specifically on the wheel on the left-hand side, when we were constructing our universe, we built a proprietary screening tool to try and identify companies that are really actively involved. So we have a 50% revenue threshold for this fund. We start off with a very broad universe of 10,000 stocks, and we look for any company in the liquid equity universe that has any exposure to the energy transition sector. And then, of course, we screen for companies with 50% exposure to the energy transition sector. We screen out fossil fuels. We screen out companies with exposure to nuclear. And, of course, any companies that are too small or in jurisdictions that don't make sense or don't have audited accounts. That gives us a universe of about 170 companies. What we don't want to be doing on this fund is investing in companies where 20% of the company's activities are coming from energy transition and then 80% is coming from something irrelevant. Then, of course, we analyze and value the companies, and we do that using 3 main pillars of analysis. The first one being the DCF model. Then, of course, we use the GARP score that is really looking at near-term earnings and cash flow growth. And of course, the last bit is the sustainability overlay, as you can see in the middle bubble. So for all of the companies in our focus list, we do dedicated sustainability analysis on every single stock in that universe and score companies out of 10, classifying them as lagging, neutral, and best in class. Then, of course, ultimately, we construct this portfolio of about 40, 50, 60 names, but at the moment, we have about 47 names in the portfolio. So typically, we would hold anywhere between 30 to 50 stocks, although we can hold fewer than 60. Now, on the next slide, what you will see is it just giving you the top 20 holdings, and it brings to light how we basically invest in these companies. For full disclosure, here's the top 20 holdings, and they make up approximately 52% of the portfolio. And you can see the upside we have to these holdings are about 15%, and this is based off our DCF valuation, where we use normalized returns to give you the valuation. And we also provide a GARP score of between 0 and 8. So anything above 5 is high growth and anything below 5 is low growth. I'm not going to go into too many details on this. I'm going to stop here and then see if there are any questions.
Muchas gracias, Jessica.
Thank you very much. We're going to start with one question that's been sent to us by Ana Ross, who is an ASEAFI associate and Capital EF.
Bueno, como bien explicáis en vuestra presentación.
As you're explaining very well in your presentation, the theme of the fund is based on energy transition in order to achieve our objective, our climate change objective. And to do that, you do an analysis of corporations that fulfill these type of requirements. From my perspective, at the end, we're trying to get rid of companies that work on traditional energy so that we can start using other companies with new energies, with less track record and less results that we can analyze. What are the risks of the companies that you have in your portfolio now when talking about the new processes of storage, transmission, distribution, and even the generation of energy for these new clean energies? I understand that some of the companies within your portfolio probably will fall on the way towards that energy transition. But how are you planning to face those risks?
That's a really good question. Thank you very much. And I guess it's also a difficult question to answer. I think any portfolio or any company that we want to invest in will have certain risks. Now, we need to take this step in order to decarbonize the world. And so what that means is we'll have to move away from fossil fuels. What we are seeing with companies like BP or Shell, they are transitioning their business models. As I said, they're moving and increasing their green energy capex, but they're doing it very, very slowly. They are overbidding on a number of projects. So, and as carbon prices continue to increase, a huge amount of risks will occur in these businesses as well. They might have seemed like a safe bet, but as we've seen with the pandemic, they are not safe bets. These companies are not safe bets. For example, BP have made a number of redundancies. Shell have made a number of redundancies. They're in panic mode and they're transitioning their business models aggressively. They're overbidding in order to increase their renewable energy generation. So BP currently produce about 2.5 gigawatts of renewable energy generation, and they want to increase that to 50 gigawatts by 2030. So in 10 years, they would like to increase their gigawatt capacity to about 20-fold. And what that means is it's going to require a huge amount of investment, something like $70 to $80 billion of investment. So they are overbidding massively for these projects, and they've already spent about $7 billion. So it doesn't mean that there aren't risks in those companies, massive risks. So that is one part of it. Then, of course, looking at our portfolio, yes, it is much newer, I would say. Yes, we are conscious that in the energy transition space, these companies are younger and the business models are still very much evolving. That is why we are very focused on investing in companies with robust cash flow generation, companies that have really strong balance sheets and are able to demonstrate that, and that are sustainable businesses. And how do we do that? Of course, we have our models, but more importantly, we're constantly engaging with these companies. We speak with company management at least once every 6 months, if not more often, to try and understand the execution risks that they face, governance risks, other material environmental risks or social risks, how they're tackling these issues in the short term, and what their plans are in terms of disclosure levels or improving upon these material issues in the longer term. And so that is definitely one of the ways that we approach it. So we don't just take a very static view, model out the companies, and forget about the inherent risks that these businesses bring. And of course, the other risk in the portfolio is there will be many subsectors which will become overvalued. And we've seen that again in the hydrogen space. So that we have taken a very active approach to managing it. And this is where an active approach makes so much more sense than having a passive approach, is because when certain subsectors become very toppy or frothy, or as you like to call it, overvalued, overstretched, we can reposition the portfolio, manage the downside volatility of the fund by moving to areas or pockets where we see much greater value and where valuations are not as stretched as some other areas. For example, we've trimmed our solar exposure from 23% to about 10%. We've increased our exposure to transmission and distribution to companies like Red Electrica, which you must know very well, and to electrical equipment space as well, where again there is more value. But equally within the storage space, within the hydrogen space, there are pockets where it's become extremely stretched. I hope I've answered your question.
Mm-hmm.
Jessica, while we were watching your presentation, I've taken a look at the presentation of your fund. In the last year, you've achieved a profitability of 72%. An investor can think, how am I going to invest on a fund who's already having such an amazing increase in the last year? Why, after such a high increase, should we continue on considering investing in your fund?
That is, again, a really good question. Yes, we have achieved phenomenal performance. I will give you just a nugget of caution saying that please do not expect us to achieve 72% return every year. It's not something that I think is sustainable. But what I will say is, this is not a short-term theme, as I mentioned before. This is not a one-year theme or 2-year theme or 5-year theme. we will have opportunities in the short term and we will have opportunities in the long term. As I said, a huge part of the economy will need to decarbonize, and we'll have to reduce emissions between now and 2030 by 33%. The reason that many of these stocks have re-rated is because of the stimulus packages that we've seen, the government policy, the support, the carbon prices being much more stable during this bout of the pandemic, rather than what we saw happened in 2008, 2009 during the GFC or the financial crisis. So there is a lot going for the energy transition theme or for climate change as a theme. So it is very much supported by policy. But most importantly, it is supported by economics. Now, if you look 10 years ago, the economics didn't really make sense. Now, renewable power or renewable generation is the most cost-effective form of power generation now. So when you start to see things like of course, you've got the consumer take-up, which is really helping. You've got the policy support from the government. But also when you start to see that the economics start to make sense, that will drive this even further. But there are many, many bottlenecks in this space. So, for example, charging infrastructure is a bottleneck. It's not keeping up with the EV space. So there are lots of opportunities for investors to capitalize on this opportunity while doing well. And that is what we're trying to do. We are not taking unintended risks. There are some players in this space that I said, this space is generally very volatile, can be very volatile, but it's really important to position the portfolio in a way that manages that downside volatility and that can have an active approach and really move around the different subsectors where you can find value. And we think we can do just that. And if you look at some of our slides towards the back, you will find that we have, and if you compare the volatility of this fund versus the comparator benchmarks, Alternative Energy Index, or the ACWI or our peers, we've managed to achieve these returns with much, much lower volatility than any of them. And I think that's a testament to how disciplined we are as a process. We will take profits when sectors become, a bit hot, and then we will put money into sectors where we still see value. We're constantly modeling out our universe. We started off 130 stock universe. We now have 170 names, and that will become 200 names. So we're always looking for new opportunities in this space. So to answer your question very quickly, yes, there are lots of opportunities in the short term and in the long term. We will do that with much lower volatility. We're constantly modeling out stocks to increase our universe. And there are short-term and long-term plays. And an active approach will really enable you to find, and we hope that we can find those opportunities for you, rather than what an ETF does is just provide a basket.
Pregunta un inversor.
One investor is asking, because you said that this high profitability will not be achieved every year, but what kind of profitability can we demand to your theme? What should be the profitability that we can expect for the next 5 years?
I think that's a very difficult question. If I had an oracle, I would tell you. I think, that is something I just would not be able to say. Mm-hmm. Really what we're trying to do within this fund is outperform a broad-based global index, which is what we think we can do, which is, outperform the MSCI All Country World Index. But obviously, we have outperformed it with rigor this last year, and it has been an exceptional year. It has been great. But again, what we aim to do every year is outperform our peers and outperform the MSCI All Country World Index. But if I had to put a number on it, I don't really know. We don't really know what's going to happen over the next 3 or 5 years. But I will say that there is a lot of buy-in from everyone in this theme. So it's not a theme that is going to die out. We have to. It is literally do or die for us. You have COVID, and then you've got climate change, the two biggest challenges that we currently face.
La última y muy breve.
Very last and very brief question. There are corporations such as Tesla or NIO that are working on the electric vehicle field, but they have a tremendous weight in energy storage. I understand that these companies are not part of the portfolio, but they could be interesting opportunities very much related with energy transition. Could you be brief in your answer?
Yes. So we are looking at these companies. We don't currently own these companies or don't have these companies within the universe, but we definitely have been thinking and modeling out these companies. We are thinking of including clean mobility within the fund. And so that more to come on this space. So maybe next time you have us, we'll talk more on clean mobility.
Muy bien, iremos siguiendo efectivamente.
Okay, thank you. We will follow the make-out of your portfolio and we will follow you. Thank you very much for taking the time to being with us.
Vamos a ir ahora con las preguntas.
Let's now dive into the questions. Finect.com/bios. Open it on your search engine. We're going to ask you, how do you rate this investment opportunity brought about by Jessica, Reddit investment director for Reuters? 10 seconds to go. For this energy transition fund, if you have checked the sheet, the performance last year, we're going to rate now the actual presentation, how she conveyed the idea. Time to vote. The funds that we have mentioned are all on the platform in Finect. You can access, you can start the contracting from different platforms. ABN Bank with the clean shares and clean asset classes. Thank you very much for being connected. I really like your participation. And if you like the video, just show it. This is the very last presentation of this third session. Can I find an asset manager with a long-term view? To begin with, it is in a private hand with over 85 years of experience in multiple market cycles, with asset managers that do the right thing at all times, not being flown by different fashion trends, trying to reach the goal of their clients. Can I find with Capital Group a long-term asset manager? Yes. And we are about to begin the first session with Jeremy Cunningham. Throughout his vast experience, he has specialized in quality corporate bonds, quality like the one he enjoys in wine tastings, and rugby and cricket. Jeremy, we are here to listen to you. Thank you very much for closing this today's session. Jeremy, you have the floor.
Very much. Thank you very much, everybody. And thank you very much for staying on and listening to the final session of today. I'm sure you've had some great sessions today. Interesting to see that last photo of me with me losing at golf to my son. So not a happy memory. But anyway, what I have to talk to you today is to talk about the global corporate bond market. And this is a market that we believe really does fulfill a key role for you as investors, as active investors into the fixed income markets. But before I get to that, maybe just to introduce you to Capital Group, to those of you that perhaps don't know us that well, or perhaps only know us more for our equity capability. And as you can see, we manage just over 2.1 trillion today, and that makes us the largest active-only manager in the world. And as you've heard, we've been managing assets actively for over 85 years. And about 420 billion of that 2.1 trillion is in fixed income. So quite a sizable level of assets actively allocated into fixed income markets. And we've been managing fixed income actively since the early 1970s. And so very established in this area, which I want to talk to you about today. And, as I mentioned, really when you think about fixed income, perhaps you're more focused on equities, perhaps. So maybe our new perspective fund. Maybe that's probably our flagship equity product. But thinking about the other side of the fence, and fixed income, there's really four key roles of fixed income when you think about it in the broader context of your asset allocation. One of those is providing a diversification to equities, to have an allocation to fixed income that when stocks struggle gives you that diversification, gives you that protection within your broader portfolio. Or income. Clearly everybody, I think globally, is needing income. And when you think about generating income within your portfolio, don't think about it coming from one place. Think about it coming from multiple different sources, because that will give you a little bit more stability when you look at the overall stream of income within your broader investment portfolio. Also, capital preservation. Fixed income, as we know, is those instruments mature at par. They're designed to give you back what you invested, what you lent, and so that sort of capital preservation also plays a role within the broader portfolio. And then obviously inflation protection, the elements of the fixed income universe that can provide inflation protection. So what I'm talking to you about today is the global corporate bond market. And really that can fulfill three of those four roles, that diversification to equities, that income generation, and also that capital preservation as well. And maybe for those that are less familiar with the corporate bond market, the global corporate bond market, maybe more familiar with your domestic sort of European corporate market. When you look globally, it is a vast market, not only because of the number of companies that issue into that market, and so sort of 2,642 to be precise, and growing every single day, number of companies that are issuing, and then the number of bonds, the number of different types of bonds that are being issued by those companies is almost 14,000 in number. So it's a very broad, diverse universe, which is absolutely perfect for an active manager that can then identify which companies are those which are offering value. And the market size is over 11 trillion. So, clearly, when we think about liquidity within the market, the global corporate market is very deep with respect to liquidity. And so even during times of stress and strain and crises that we've seen, the global corporate investment grade market offers you that liquidity as well as that breadth of opportunity. And as you can see here, it is a marketplace where the dark blue bar, you see the global corporate market has grown dramatically over the past decade or so. And that's primarily because companies have really sought financing through issuing bonds, the capital markets, rather than securing financing through the banking system. So the corporate bond market is now a proper functioning liquid broad marketplace. And then when we think about, returns, and I think a lot of people maybe think about fixed income and they think, well, fixed income rates go up, you get negative returns. That's not necessarily the case. And you can see that here where, where we're looking at the market, when you look back at the beginning of 2004 to the mid part of 2006, where rates rose quite substantially, you saw positive returns from the corporate markets during those periods as well. So certainly, when you think about global investment grade corporate market, think about it as a core market. And those core markets have delivered positive returns across different interest rate environments, so rising interest rate environments as well as falling interest rate environments. So what I specifically want to sort of focus in on now is the vehicle that we launched, the Capital Group Global Corporate Bond Fund. It's a UCITS regulated vehicle, and we launched it back in 2018. But we've been managing global corporates portfolios and for our clients since 2012. So long experience with respect to managing the global corporate type of strategies. And we wanted to bring that expertise to a broader array of clients across Europe and in Asia. And so therefore we launched that vehicle in order to be able to allow our clients to invest with us through that means. And as you saw, when we look at the global corporate marketplace, it's a very, very big, broad marketplace. And so we don't want to rely on one individual that has to try and look across that massive marketplace. At Capital Group, we have a very distinct approach. We call it the capital system. And it is an approach that has multiple highly experienced managers investing the portfolio. So in the case of the Capital Group Global Corporate Bond Portfolio, we have 15 investors that are investing the strategy. Each of those investors are analysts in specific areas of the broad universe, and they identify the best companies, the best ideas in their sectors, and then get those ideas into the portfolio. So it is a portfolio, in effect, managed by 15 specialist investors, overseen by an individual, and you can see in this case he's called Demir Bettini, who's called the Principal Investment Officer, and he looks across the entire portfolio and ensures that the overall risk of the portfolio is in line with where we want it to be, given where we are in the cycle. But the actual individual companies that are put into the portfolio are chosen one by our analysts that you can see on the page there. Now, those analysts are highly experienced and they have deep expertise within their specific sectors. But at Capital Group, as you've seen, we are an equity manager of significant size. And therefore, we have deep resources globally that allow us to access to companies globally because we are major investors across companies globally from an equity perspective as well as a fixed income perspective. And our analysts on the equity side and our analysts on the fixed income side share their research. They visit companies together. They see chairmen, they see CEOs, they see CFOs together. And typically, as a fixed income investor, you wouldn't get access to that level of companies globally. But from an equity perspective, we do get access, and therefore we collaborate across equity and fixed income in order to really get that information advantage. And we have different means. So we have what we call clusters or swarms, where analysts from interrelated sectors also share their research. And it's all focused on one thing, getting that information advantage, getting the highest quality company research, and therefore getting the best ideas, the best companies into the portfolios. So really, when we think about how we drive returns within the global corporate portfolio at Capital Group, really 90% of the added value comes from company selection. It's not about market timing, trying to guess when the market's going up or down. It's really about identifying which companies are strong companies or improving credits that are mispriced. And so our 90% really of the value of this strategy comes from the bottom up. And what that means, or the benefit of that for our clients, and that's really what lies at the heart of this, why do it this way? Because it really benefits our clients, is the consistency. We're able, therefore, to deliver on a consistent basis on the objectives that our clients demand of us. So that really comes from that differentiated approach, and the portfolio is built directly by investment analysts and based on extensive research and that long tenure in the industry that our team of analysts have. The other point to mention is that when I say this is a global investment grade corporate portfolio, I mean it is a global investment grade corporate portfolio. It doesn't have added elements that would deviate the portfolio. So it doesn't allow high yield or junk or sub-investment grade bonds. We do not allow that. We don't allow any currency risk in the portfolio. And so because when our clients invest with us for a global corporate portfolio, what they are after is global corporate exposure and the value to be driven by that specific means. You can see this is the return of the return profile of Lux funds, but really I wanted to focus really on the longer term track record to ensure that to give you confidence, I guess, in as much as we've been doing this a long time and we have consistently generated year in, year out, very strong excess returns. And as long-term investors, as you heard at the beginning, Capital Group are long-term investors. And the reason we have a long-term investment horizon is we believe that aligns us with our clients' objectives. It also aligns us with the best approach to extract maximum value from the marketplace for our clients. So it's a very strong track record of results that we've delivered to our clients over the years. So just in summary, we have, for global corporates and indeed across all of our corporate strategies, we have a very distinctive investment process. We have analysts actually managing money, not just making recommendations. They're actually managing money. And that is a absolutely vital part of our differentiated investment process, because we believe that gives you much better investment returns, much better investment decisions. This portfolio is also, alongside all of our portfolios, systematically screen for ESG requirements, and that is embedded within our research process. And it's very much a screen and engage approach rather than a screen and exclude approach. A highly experienced team of investors and a very stable team of investors as well. So not only have they had a lengthy amount of time in the industry, typically a major proportion of that is with Capital Group. They're a dedicated credit team. They're not doing other things, and they're not just dedicated in the sense that they are just focusing on the corporate markets. They're also just focusing on the investment grade corporate markets. They not also have responsibility to the high yield market or anything like that. So when you invest with this type of portfolio with Capital Group, you get 100% of our analysts' attention in identifying the right bonds to buy. And then on top of all of that, we have a highly sophisticated, as you would imagine and as you would have hoped, a highly sophisticated risk management approach. Best-in-class systems, but also best-in-class analysis to really understand the risk of portfolios, how they could change during different scenarios, and is it in line with where we want to be given where we are in the economic and the market cycle. So thank you for listening. Hopefully that's useful, and I think we've got some questions.
Muchas gracias, Jeremy.
Thank you very much, Jeremy. Indeed, we have a question put forward via video by Diego Gonzalez, one of the advisors that you can find on our platform from Cobalto AF. Ingo's video. I would like to ask you for an investment-grade fixed income bond in this bond context where the yield offered is almost zero, obviously with a high level of solvency. How can you secure profitability and interesting yields where this asset class is paying zero, whereas the management fees in the fund are still there? And what is your approach about this getting bonds out of the Eurozone and thus increasing profitability? So in this sense, I would like you to elaborate a little bit on your philosophy and your strategy to generate yield despite this context. Thank you very much indeed.
You're right in as much as yields are very low at the moment with respect to where they've been historically. And, that is why, we would say that an allocation to this type of strategy is not it's not your whole allocation to fixed income. But it serves a role as a very core additive allocation that plays those roles that we talked about at the beginning. One of those is a capital preservation, income generating. So the types of yields that in the portfolio it's not zero, but it's sort of 1.5%, 1.75% type of yields within the global portfolio. And so when you think about that as a portfolio yield in itself, it's not zero, but it's not 5 or 6% where it was a few years ago. But what it's doing is it's giving you an additional sort of incremental source of income. You can obviously allocate to other sources of income, but a core allocation to this type of real solid portfolio is very beneficial. And when you look back, if you look at those return schedules that I showed you earlier on, over the sort of last 3 to 5 years, this type of asset class has delivered sort of 5 to 7%. We would suggest that going forward, that over the next sort of 2 or 3 years, that's probably going to be sort of 1.5 to 3%. And so still additive to an overall portfolio with a very low volatility, particularly especially if you have a portfolio that is in high quality, well-chosen names. The other part of your question, I'm not sure I understand, but I think you were talking about getting bonds out of the Eurozone. I think perhaps you were, correct me if I'm wrong, but I think perhaps you were referring to the fact that obviously there is a sort of cohort of bonds within Europe that are negatively yielding or zero yielding. So, and I would agree. And the value there is not very attractive. And that is exactly the reason why, investors that have traditionally focused on their domestic market, i.e. European corporate bonds, should look to move into a more global context, because there's a lot more value in the US market, but not just the US market, Asian markets as well, that are included within the benchmarks, the global benchmarks, and allows you then that ability to invest globally, more diversified, and also incremental yield, but not moving too far away from core quality names.
Jeremy, preguntan precisamente en qué.
Yes, they're asking precisely in which regions the fund is overweighted at the moment. In which regions, please?
Absolutely. So when you look at the portfolio, we're very much overweight US names versus the European names on that metric, and then away from that, when you look in Asia, we're also overweight Asian names, and that's some Chinese companies. China's in the benchmark, but also India, Hong Kong, for example, as well. So there's a lot of overall in Asia, we're slightly overweight as well. So what I would say is that when you look at the construct of the benchmark, it is mostly, a bigger proportion is in the US, and actually I'm just looking here. Yeah, so you're about 60% US, sort of 30% Europe, and some in Asia as well. And so we favour US and we favour Asia over European names.
Preguntan qué plazo de inversión deberían.
Which investment term shall an investor have? What is the horizon?
Yeah, I think that's a great question, in fact. And, as I mentioned, we're very much long-term investors. And we would say a minimum of 3 years, but 3 to 5 years would probably be a prudent timeline to have this type of allocation. And when you look back over history, don't take my word for it. Look at back over history. Typically, a sort of a 3 to 5 year holding period across most fixed income asset sectors are beneficial. I think all are actually beneficial in the normal sort of core markets.
Hay un par de preguntas.
There's 2 questions about the risk behind this type of investment. You may imagine now one of the key questions relates to inflation. What is the inflation perspective? Because lately the markets have just started to factor this in the equation. What do you think of inflation's risk?
Absolutely, I think, and that's a very real risk. And so, one of the 4 roles of fixed income is inflation protection, and you certainly should have that at the forefront of your mind as we move into the next phase over the next sort of few years, because that's one of the key focuses, isn't it? We know as we come out of this pandemic, as the huge deluge of stimulus that we've seen globally, from both fiscally and monetary, gradually gets withdrawn, but nonetheless, it's very likely to give you some inflationary impulse coming through globally, and so therefore, what to do in these types of in a corporate portfolio, and this is, at the very forefront of everybody's mind, including our analysts. And so, when analysing a company, it's the key thing here is to understand how exposed that company is to those inflationary pressures. And that is why that bottom-up analysis is absolutely key. Because when you're looking at companies that perhaps have balance sheets and construct of their business models, which is beneficial from an inflationary environment, or are in industries which are beneficial from an inflationary environment, then that's obviously very supportive from a fundamental perspective. But it's all about doing that underlying fundamental analysis. And so that's a sort of quite a long way of saying this portfolio can benefit from even in an inflationary environment, as long as you do your company selection correctly.
Mm-hmm. Estamos acabando, nos quedan un par de...
We're about to finish, but just a few more questions. In terms of valuations, since we've had very good performance in the last few years, analysts argue that there is a bubble really in the most conservative part in fixed income, corporate fixed income. What is your view on this?
It might be a very strange thing for me to say, but if I was going to buy an ETF, I wouldn't buy it. Why would you buy an average market that's overvalued, basically? And as we've all seen the great returns that took place last year, particularly the latter 3 quarters of last year. So if someone offered me an ETF, I wouldn't buy it. But if somebody said, look, don't forget, when you look in the global corporate marketplace, there's been some sectors that last year that have performed brilliantly. And so all the value has been squeezed out. And that's what drove the market last year and the overall returns. But there's still a lot of companies and a lot of sectors that are really wide and offering value relative to their history. In sectors that, remained under pressure for the entire part of last year. And so there is still a lot of value from a company by company perspective in some sectors, more sort of pro-cyclical sectors, retailers, for example, some transportation companies, even the wireless and the wireline type of sectors where, we're going through huge levels of evolution in that sort of marketplace. Getting those companies that are at the forefront of that, they're going to offer value. So absolutely, it's expensive from a top-down perspective, so please don't buy an ETF. But from a bottom-up, there's a lot of value. So if you looked at our portfolio, just to give you some context, you looked at our portfolio and you looked at the overall risk of our portfolio relative to benchmark, we're underweight, overall risk. Mm-hmm. But within that's made up of underweights those sectors that have really performed well, and building overweights in companies that we believe will benefit from this next phase.
Mm-hmm. Ya terminamos con esta, porque dice en el contexto actual.
And we finish with this one. Under the current circumstances and with the low profitabilities that can be expected from certain assets, to what extent is it necessary to take risks? This is a question that this user is formulating. To expect this 1.5, to what extent is it worth to take certain investment risks?
Yeah, I think I get the gist of the question is, are there better places to take risk in the market? And our view is, when you think about purely just staying on the global investment grade corporate, this is a high quality part of the fixed income universe that we wouldn't take too much overall directional risk relative to benchmark, as I've mentioned, but really, even though our philosophy is always that we generate 90% of the value from the bottom up, I don't think it's ever been more important than it has today, because that's how you generate the value. So when you're taking risk, don't take directional market risk. Take the individual name selection risk. It depends. And this comes back to my final point that I made, where we have this multi-layered risk management system or approach or capability, because it's all about understanding where you're taking the risks. And this is not a time to take that top-down operational, top-down sort of directional risk. It's the time to take that company-specific risk, because you are getting paid for that risk, depending on where you look.
Pues muchísimas gracias por tu tiempo.
Well, thank you very much for taking the time to be with us this evening. Jeremy, thank you very much for closing this first day of BIOS 3. It's been a pleasure having you with us. Thank you. Okay, so we're about to finish. We only have 3 more minutes left to get to know your opinion. There is the URL address, finect.com/bios, or you can capture the QR code. And let's go with the last questions. How interesting do you think it is investing in fixed income, in corporate fixed income? And the time to vote, it starts now. You got there the information about all the funds that you can find at Finect. We're about to finish, and we would like to do so by thanking you for your participation. And let's go now to the second question that we're seeing of this presentation done by Jeremy Cunningham. What do you think? How good a job he did in giving us this presentation? Did he give us a good explanation? Did he answer the questions correctly? The time to vote starts now. Jeremy Cunningham, Fixed Income Investment Director of Capital Group, who's brought us these ideas with which we're finishing this first BIOS day. But first, we want to hear your feedback, because we want to improve things for the coming BIOS versions. And the last question is your what do you think about BIOS 2020? You have different options. Do you thought that it is useful? Did you like? Was it very interactive or not? So time to vote is now. And we're going to ask you for your opinion about this session as a whole, this BIOS 3, this Best Investment Opportunity Summit. Thank you very much for participating, for letting us know, etc. I hope that it was useful. Thank you very much for being there, and thank you very much for the likes that you've clicked. Thank you very much to your partners, Aberdeen, BMO, Capital Group, BNY Mellon, Nordea, Natixis, Ideas, Schroeder's, Bontobel, our collaborator, EBN Bank, so that you will get to know about these clean classes funds and the associations of professionals joining us. We're going to give you the presentations as well as the link to the test at the URL finect.com/bio, so that you can do this test. And thanks to our partners, ASEAFI, CFA Society Spain, and FPA. Thank you very much. Tomorrow more, maybe better, and we'll start tomorrow at 4 p.m. Thank you.